Well, the good news is millions of us are hitting the road this week for that midsummer trip to the beach or the campground. The bad news is it's going to cost more. Gas prices now average $3.63 a gallon. That's up 14 cents since the 1st of July. This time around, though, the reason for the increase may be a little different. Here's Ben Tracy.
Here in Los Angeles, gas prices top $4 per gallon. That's 24 cents higher than a year ago. The increase is mostly driven by the rising price of crude oil. Among the factors pushing up demand for crude are financial institutions. Investors have purchased contracts to buy a record 495 million barrels of crude oil. That's about twice as much as last year and as much oil as the United States uses in an entire month. Bart Chilton is a commissioner at the U.S. Commodity Futures Trading Commission.
We've seen all too often in the past, we're having an excessive concentration of power in the market. And using that concentration in a speculative way can actually increase the price that consumers pay at the pump.
Major U.S. banks are now heavily invested in physical commodities such as oil, coal, and metals. J.P. Morgan Chase has $14.3 billion in commodities, Goldman Sachs $7.7 billion, and Morgan Stanley $6.7 billion. Congress and the Justice Department are now questioning whether that allows big banks to manipulate prices of raw materials.
Banks should get back to being banks. They should get back to lending to small businesses and to individuals.
In 2003, the Federal Reserve loosened the rules that allowed big banks to buy physical commodities such as oil and metals. That's driven up prices for consumers. And Bob, the Fed now says they're going to review their ruling.
Okay, Ben, thanks.